Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, Memorial Day in the U.S. just passed, and the Federal Housing Authority there is reporting brand new housing sales were supposedly beating all market forecasts by a huge margin in April. Ross, do you see similar reports ahead for Canada?
The USA Housing Stats, Federal Housing Authority, they generally release new housing data seasonally adjusted. So I would suspect that that's why these guys are so off with their forecast. So I'll tell you, our forecast for the new housing sales, not starts, sales in the United States, a number that isn't even presented in Canada, by the way, was pretty much on. Now, it's pretty easy to make that forecast when you're looking at a lockdown of a nation in March and you're forecasting for April, May, and June. That's pretty easy. What happens, though, Jim, is that when you seasonally adjust the numbers, as we have seen across Canada over the last couple of years, it creates a false positive in the data. So the data starts to look, or the stats start to present an image of the market that it is far better than what it actually is. When you study housing markets and you study how organized real estate across North America has presented data to the public, generally speaking, they want to present seasonally adjusted data because it always presents a more favorable outcome to the market. So in other words, when a market is turning negative, it can present the market as being positive. And that positive message, if it's sustainable for 1 or 2 months via seasonally adjustments, it can reverse the behavior of home buyers. It also can be allowed to delay responses because of policy changes that governments may put in place. And in the States, they're reporting new housing sales is what you're talking about here. And I think that's why all their analysts in the States were so far off. You see, when we look at the data in the States now, again, even though they have brand new housing sales data, which we don't have in Canada, we have starts, completions, absorbed. We don't have sales, though, per se. They're basically reporting on the sales that took place in that month. Now, again, because it's a survey, the way it's reported, that's already a latent number by the time it arrives for the month of April. Obviously, they don't have a true reading for the month of April, and they won't to be able to collect that data. You probably couldn't do that. Maybe June at the earliest, meaning the end of June. You certainly couldn't be doing it at the end of May, simply 3 weeks after the end of the month. So in Canada, we don't see brand new housing sales numbers. Now, we may get numbers out of Altus. We may get some regional numbers from some shill for the new home building industry that gets produced. There's a couple of well-known ones that were also tied up with secondary mortgage lenders in Canada. But there's no accurate data where this is collected. CMHC does not collect brand new housing sales data. So we're not going to see that. But what we will see, Jim, is similar numbers come across and be misreported to the public by CMHC and the banks. Because again, they're latent metrics that are measuring behaviors, actions taken by Canadian home buyers that are not even relevant to the market that they're being reported for. So what I mean to say by that is this: a new housing start in Canada being reported is normally a cyclical item that you cannot seasonally adjust because the cycles change. They're not similar. If you're going to try to base your seasonality over a 10-year window, or it's not going to be long enough, over a 30-year window, then all you're going to do is have, when the market rolls over, the margin of error increase, rendering your forecasts not possible. So we're going to see these misreads of data in Canada over the next couple of months, and some of them have already taken place this week. You look at the Terranet National Bank House Price Index. Now, so your listeners know, Terranet National Bank has blocked us on Twitter, as many of the so-called housing analysts have over the years, because we issue a tweet. We issue a tweet like with one word: false, wrong, inaccurate. And for some reason, these people are not able to handle a critique of what they're saying. In other words, they're not able to disprove our tweets with their data. There are about 12 housing analysts across Canada now who have all blocked us because they don't want our contrarian opinion to appear in their feed or below their tweets. It's something that is beyond how we look at things. We say if we're saying something is wrong, challenge us. Let us prove that what we're saying is true. You don't run from a contrarian opinion. You should run towards it and embrace it and seek to disprove that you were wrong in the first place. But these housing analysts don't seem to have this approach. They're so afraid of being discredited, they block you, as Terranet National Bank did. Now, that's understandable. When you release a housing report that claims house prices increased in April across Canada. I hope you listeners understand how absurd this is. Terranet National Bank reported this is one of the greatest April house price gains in their recorded history. At the same time, house prices are dropping in April. Anyone who goes into the subdivision level across Canada and you try to find similar homes that are selling, you're going to see that those homes have not increased one penny. Yet Terranet National Bank said, they've increased at a record pace again. A record pace not seen since back in 2017, I think they said. No, what you're doing is you're recording the group of homes that sold in that month. Now, you're also recording sales on a latent basis because these are closed transactions. So what Terranet is actually saying is, housing sales that were entered into in the months of November, December, January, and February, which closed in April, reported a year-over-year increase in their aggregate average sale price, which again, as we told listeners on the show, has nothing to do with house prices. It's simply how qualified a group of buyers is, and how much money they're able to spend. So this is what happened today with this report, Jim. But I would also like to end this discussion with the following thought. The real estate market is reawakening right now. It's coming out of its slumber. There are Zoom calls going across this nation as retailers are reopening their stores. Large chains, are talking to their employees, trying to convince them to come back to work on a limited basis. These Zoom calls, if you really listen to them, are very, very negative for probably the next year of our economy as a nation. You also have to look at what's being reported. And if you're not studying it, you're going to miss this. People probably have forgotten already that Leon's and the Brick, two stores which are solely dependent on the trading cycle in terms of their growth and their employee counts, have just said that they're going to look to close about 72 stores and lay off around 4,000 workers. You're going to be hearing similar things across all different stores. We're already seeing the retail that we're lucky that we're able to piggyback on some of these Zoom calls because we have so many contacts that are trying to assist us and understand what's going on with the housing market. And some of the things that we're watching are just unbelievable. What we can say is, had the government not instituted some of these wage supplement programs for these companies would not be reopening today. The only reason they're reopening is because they only have to pay sometimes 0% of the wages when you look at how the calculation's done. We also are watching as people are questioning even going back to work. They're saying, I was getting $500 a week on the CERB. Now, of course, they're not thinking about that there's no CPP, there's no income tax, there's no unemployment insurance deducted from that payment. Those deductions really are, you're going to have to make in the future. But people are looking at $500 a week as a living expense. And in dual income households, that's $1,000 a week. And they're seeing that reality. That reality is also coming in these calls to go back to work, where people are saying, hey, I'm not making as much money going back to work than what I was making sitting at home. And anyone who's familiar with seasonal work, like the fisheries or the loggers, you understand how the dynamics of that plays out in a community. And we are going to start to see that in a far broader range across the nation. So as this nation reawakens, as we, really, I've really picked up on the Mazda commercials, Jim. I thought they've really branded this quite well. But the realty market is going to reawaken. And the very first signs of a reawakened housing market will be declining home prices. You're going to then hear realtors and newbie housing analysts spouting out about, oh, well, it's not that. It's because the sales were shifted more heavily towards condos versus single detached home. Well, my answer would be that happens every single month. I don't know what you're why you're trying to jump on the bandwagon now, after you ignored it when prices peaked in 2016 in British Columbia, peaked in 2017 in Ontario, peaked in 2020 in Quebec, peaked in 2013 in Alberta. Why weren't you jumping on that bandwagon then? You're now only jumping on to it now that housing prices are declining, and you're looking for a savior. Well, your listeners, when you hear year over year or month over month, housing prices, average selling prices are declining, that is the moment you know that the housing market has restarted. That will be just the opposite of what you hear everywhere else. When we're talking to our members through their metrics, we're just getting ready to do a major new update to all of our housing because we've had to slow down over the last couple of months. It would have just made our forecasts look wrong because we couldn't adjust them as rapidly as changes were taking place. Those folks are going to hear what's going on in the market, and they're reading about it months before you're going to hear about it eventually be reported in stats, which is exactly what just happened in the United States with their brand new housing sales markets, shockingly beating all the forecasters' forecasts by a huge margin. What I'll tell you is, look at new housing sales when that get reported into May, June, and July in the U.S. Because the rosy reporting of missing forecasts that is happening right now won't be happening as they go forward. Because seasonal adjustments start to be mitigated. Errors in the seasonal adjustment strategy begins to be mitigated the longer a housing market moves in a direction. You'll see the same thing take place in Canada. With that said, I can tell you the market is now reawakening, and the new reality that is about to hit is there for everyone to see.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Ross Kay. Ross, today the Bank of Nova Scotia released its second quarter earnings report, and earnings were down 41%. Is this what you've been talking about in previous shows?
Well, the underlying data, Jim, is what we've been talking about. The earnings report is talking about an earnings drop because they had, basically what they had to do is they had to keep more money back for future risk that they're measuring in their loans portfolio. So when you look at the actual numbers, you'll see Bank of Nova Scotia really presented information that was basically the same as what it was last year. There really wasn't a drop in earnings of 41%. It's just that the way that they do their accounting shows there was a drop of earnings of 41%. And if they hadn't had the outstanding growth in their banking services sector, those earnings dropped because of that shifting of cash into basically an insurance fund, wouldn't have been offset to what the degree that it was right now. So when we hear these comments about earnings drops or you hear these earnings reports, if you weren't budgeting for these banks having to retrench at some time, you were going to be caught off guard. Because what the banks, there's a short seller in the U.S., Steve Eisman. He's been shorting Canadian banks, I think, for a couple of years now. And his claims back last year, they were on BN a full year ago, so 12 months ago. So this isn't, he's just not getting lucky, and this is happening because of the lockdown. He was actually saying back then that the Canadian banks weren't actually putting aside enough money for insurance and to insure their portfolio against defaults. And he said sooner or later they were going to have to do that. Well, anyone who understands how the mortgage market works and you understand how a housing market works, you would understand that whatever Mr. Eisman is reading is 100% correct. And his analysis was 100% correct. Because sooner or later, you need to start putting money aside for a rainy day. In other words, if your paycheck doesn't come in and you can't make your mortgage payment, then you're going to lose your property. You're going to have to sell it, or you're going to wait long enough until a bank takes it over from you. Well, the bank has to approach things the exact same way. They can keep waiting for the negative trend to appear, or they can start putting money aside as an insurance policy. And that's what the Bank of Nova Scotia reported today. Basically said, I think they put away about an extra 1.9 billion. I'm not 100% sure on that, so don't take my word. You have to go look at their full statement. We haven't had a chance to go through it yet. But when you're putting away that amount of money, of course your earnings in the quarter is going to reflect it. All other Canadian banks you're going to see happen the exact same thing. Now, what I haven't said in previous shows is this. I believe the CEOs of these banks have watched what has happened because of COVID, and they have strategically decided to take the hit with Q2 earnings. That's what I believe has happened. I believe these CEOs knew they were going to have to take the hit, and they decided to take it while the country was still in lockdown. Because as we reawaken, as we talked about in the previous segment, it's going to allow them to present a better image of their bank, which that is their sole and exclusive job, to present the best image of their bank possible so that shareholders have a valuation gain, so that dividends are continued to be paid. That is the sole role of a bank CEO. So we believe that probably sometime in March, when it was deemed that we were going to go into lockdown, all Canadian banks made a strategic move, which only made common sense from a CEO's perspective, to use second quarter earnings to take the hit. Now, we will see as we go into Q3 if that decision was the right one or not. I believe it was the smartest decision that the CEOs could have made. Will be interesting to see how that plays out in the value of bank stocks. So if you're an investor in bank stocks, I suggest you talk to some advisor and get them to give you some perspective on what I've just said here on the show and how that could impact your stock price. We don't believe in buying bank stocks to ever sell them. So our philosophy is a little bit different. We believe you buy a bank stock the same way you buy a house. You buy it and you're going to keep it until the day you die. You're going to use it to collect the dividend, and whatever the best dividend rate you can extrapolate from that stock is the sole role that stock should play in your portfolio. I'm just saying that's how we approach it. But then again, Jim, we approach housing the exact same way. You don't approach housing that you're going to sell it someday and reap a windfall. You approach it that you're going to keep it for the rest of your life, and then when you die and pass on, the next generation inherits the wealth that home held. You don't need to sell your home. You only need to continue to own it until the very last moment.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Ross Kay. Ross, a couple in their early 30s in Toronto earning a combined $88,000 a year are considering buying an $800,000 home. They have over 20% ready for the down payment saved up. They're looking to pay about $2,800 per month to own it. What do you think they should do in this case?
My advice for them, Jim, is not going to be the advice that they want to hear. Because I'm going to tell them, hey, you should still buy a house. You just should be moving to somewhere else to buy it. A couple early in their 30s are just beginning to set down roots. Now, they can choose to live in the Greater Toronto area if they so desire. But they really need to sit down and look at the financial outlook for the next 50 years of their life. Is the Greater Toronto area a place that a combined household income of $88,000 a year should even be considering living in? Why do I say that? You can probably move to other parts of Ontario that still have great climate, great features, your Walmarts, your Boston pizzas, everything that you could want. And you probably could be saving around $1,400 a month in ownership costs. So if you take $14,000 a month, we have to understand that's after-tax money. So you basically could cut your gross debt service ratio. So when I'm looking at the numbers you've told me, I'm assuming these people are maxing out at a gross debt service ratio of probably 38% is what they're doing. So these probably are a high credit score couple, which would coincide with them having a 20% down payment in their early 30s, considering buying an $800,000 home, which would equate to around the need to qualify in that 37 to 38% income, which in turn would mean you have to be a high credit score. You've had a good credit history. You're going from around, let's say for 38% for the sake of the argument, you would go from a 38% household expense, home ownership expense, down to a 19 home ownership expense. by moving to another city. What that means is you have a household combined income of $88,000. If you move to another city and both people are still working, and you take minimum wage jobs in Ontario, on a 40-hour work week, you should be able to bring in $56,000 to $58,000 a year. Okay, that amount of money with the savings in the home ownership cost means that even a minimum wage job, you're going to get ahead further than making $88,000 a year combined and buying an $800,000 home. You're also going to, over time, or even forget that. Let's say that even one of the two of this couple were able to keep a similar job, and their income was only to drop $15,000. Okay, that means after taxes, they're going to be way further ahead setting up life somewhere else. They're going to have more spendable income available, meaning if they want to buy a new Honda Civic on a $300 a month rent, they're able to do that. If they want to buy a house trailer and go to the provincial parks, they're able to do that. They want to take a trip down south once a year, they're able to do that. They're able to do that with less risk. Because in a worst case scenario, you probably, where one person gets laid off, you could probably still afford to cover that house if you move to a lower cost community. I would also tell most listeners out there right now the following. When you're looking at house prices, you really need to be doing a calculation on land cost and cost for the house. You need to get away from this concept right now of a house price being the whole package, because it never is. It's always a land cost and a house cost. In other words, if you're able to buy the piece of land for $300,000 and it costs you $500,000 to build the house on it, that would be an $800,000 property. Property, house, land are three different things. Property to us is an all-inclusive where both the land and the house are included. Why this matters is this. Like when you look out in your way, Jim, Abbotsford, the land values that the municipal assessment offices come up with, single detached out in Abbotsford, they're about 11 to 12%. The land value itself lower than what it was last year. They're going to drop again when your assessments are redone here and again in July. Okay? That is a huge savings. Now, if you just simply wait, let me end this discussion about this couple. What my advice to this couple would be is this, because this is how much it matters. If you simply delay your purchase and you purchase your house in the right month, so over the next 12 months, you simply buy the home you're looking for in the correct month you should be buying it, you're probably going to save, like regardless of the correcting housing market. So we're talking in a totally flat housing market. You would be saving on average about 10%. The average home in Canada, let's say $500,000 for the sake of the argument, we'll just use what the average home buyer is paying. The average home is worth substantially less than that, by the way, folks. The average home buyer is paying $500,000. So, 10% is $50,000. Now it's $50,000 plus it's all the interest that you'd be paying on that $50,000 over the next 25 years. It's the CMHC insurance, if you're high ratio, that you'd have to pay. It's the higher property taxes on the property that you'd have to pay, because property taxes are generally assessed when there's a turnover on when the house is sold, on what that selling price was. The appraised value of the property as it goes in the assessment office is skewed based on the most recent sale if one has taken place. Your cost of repairing that home will be less because you're buying a higher quality home. So not only are you getting a 10% discount, you're also getting a higher quality of home, meaning it will need fewer repairs over the next little while. If you're smart enough to be purchasing a house which recently had a new roof for the sake of the argument, you also know that your roof rotation is going to happen 12 years and 12 years. So if you plan on living in the house for 25 years, you will be selling your house with a new roof with only having to buy roofs twice. If you purchase a home with a roof that's 5 years old, your cycle is going to cost you more, and you're not going to be selling a house with a new roof, which means on the other end, 25 years from now, your house is going to be worth less. All of these sort of things have to be taken into consideration. Even the timing on the roof. Remember, we're only talking about one thing here. We're not talking about an asphalt driveway. We're not talking about windows. We're not talking about kitchen cupboards, bathrooms, flooring, carpets. Carpets is always one of the big costly items, or flooring in nature, by nature is one of the most costly items. We're not talking about any of those. We're just talking about a roof. Your roof is going to cost more money the longer it takes before you replace it. If you haven't budgeted for that and saved it because you made a right purchase, you purchased the right home at the start, which allowed you to forecast your next 5, 10, 15, 25 years of expenses, it's going to cost you even more money. It's very easy, by just simply choosing the right month to buy your home. And that changes depending on the class of home that you're going to buy. And it changes with municipality, it changes with the city, it changes with the new housing stock, the existing housing stock. All these things interact with one another, the demographics in your community, the economy that your province is experiencing, the seasonality of actual weather patterns in your province. All those things make that decision about which month very unique to you. But if you do it right, you're going to save a staggering amount of money over your lifetime. This couple in their 30s is a little bit different, because my advice to them would be, if you're only earning $88,000 a year, which is about, that's got to be about 40, almost 40%, 30% above the Canadian median household income. You're better off not to buy in the GTA at all. You're better off to move, take a lower paying job, because you're going to be able to build wealth more rapidly by making that decision. All of your living costs are going to be lower as a result, excluding food and electricity, which are probably going to be the same pretty much wherever you live. That's the advice what I would give to that couple. I really would steer away from trying to construct a home ownership profile for them on an $800,000 home. Now, when we take the lockdown into consideration and the road ahead, that is a totally different discussion going forward.
Ross, thank you so much for the update.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.